For 58 years, Warren Buffett walked past one of the greatest investment opportunities in American history. Every single day, he drank it, he sold it as a child, he watched it grow into a global empire, and he refused to buy a single share. Then in 1988, at age 58, he finally changed his mind. He invested $1.3 billion into Coca-Cola, making it his largest concentrated bet ever. Today, that decision generates $816 million in dividends every year. That's $2.2 million every single day. But here's what makes this story truly fascinating. This wasn't about discovering some hidden gem. Warren Buffett knew Coca-Cola better than almost any company on earth. He'd been intimately familiar with it since childhood. So what invisible force kept one of the smartest investors alive from seeing what was right in front of him for nearly 6 decades? And what finally broke through that mental barrier in 1988? The answer reveals something crucial about how even brilliant minds can be trapped by their own success, and why the best investment you never made might be one you've looked at 1,000 times. To understand this story, we need to go back to late 1987, a moment when the entire stock market was still reeling from crisis. October 19th, 1987, Black Monday. The Dow Jones plunged 22% in a single day, the worst one-day crash in market history. Panic selling, margin calls, financial chaos. Every stock got hammered, the good, the bad, and the exceptional. By early 1988, quality companies were trading at fire sale prices. Fear had created opportunity, and Warren Buffett, at 58 years old, was hunting. But here's the thing. Buffett wasn't looking at some obscure industrial company trading below book value. He was looking at something he'd known his entire life, Coca-Cola. Picture young Warren in 1930s Omaha, 6 years old, buying 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents. Then walking door to door, selling individual bottles for 5 cents each, a 20% profit margin. Even as a child, he saw the economics. He drank Cherry Coke daily. For decades, he understood the product intimately, the brand loyalty, the pricing power, the addictive appeal. And yet, for 50 years, he never bought the stock. Why? Because it didn't fit his formula. Warren Buffett had been trained by Benjamin Graham, the father of value investing. Graham's philosophy was simple and powerful. Buy undervalued assets trading below book value. Find companies the market had overlooked or beaten down. Buy them cheap. Wait for the market to recognize their value. Profit. This approach made Buffett wealthy through the 1950s, 60s, and 70s. He became legendary finding cigar butt investments, companies with one more puff left in them. Cheap, undervalued, profitable, but Coca-Cola? Coca-Cola never fit that mold. The company consistently traded at premium valuations, above book value, high price-to-earnings multiples. By Graham's strict criteria, Coca-Cola was always too expensive, so Buffett avoided it, year after year, decade after decade, even as the company grew into a global powerhouse. Then something changed. In 1981, Roberto Goizueta became CEO of Coca-Cola. Goizueta refocused the company. He sold off unrelated businesses, streamlined operations, launched aggressive international expansion. The strategy was working. But in 1985, management made a spectacular blunder. April 23, 1985, Coca-Cola announced they were changing the formula. New Coke was born. The reaction was immediate and fierce. Protests, boycotts, outrage. People were emotionally devastated. Some stockpiled the original formula. Others organized rallies. By July 11th, just 79 days later, Coca-Cola capitulated. They brought back Coca-Cola Classic. The stock took a hit. Analysts questioned management competence. But something remarkable had been revealed. The new Coke disaster proved the brand's power. People weren't just customers. They were emotionally attached. The moat wasn't just financial, it was psychological. Warren Buffett noticed, but he still didn't buy. Not yet. Then came Black Monday, October 19th, 1987. The crash. Coca-Cola fell with everything else. By January 1988, the stock was trading at $2.45 per share. The market was pricing in almost zero growth potential, as if Coca-Cola's international expansion was worthless. Buffett's friend and neighbor, Don Keogh, was president of Coca-Cola. Keogh had been explaining Goizueta's transformation strategy for years. Now the company was fundamentally stronger than ever, and temporarily cheap. On January 15th, 1988, Warren Buffett started buying. Over the following months, he invested $1.3 billion. He acquired approximately 400 million shares, 6.2% of the entire company. It immediately became Berkshire Hathaway's largest single position. This was different. Higher valuation multiples than Buffett usually paid. More concentrated than his typical approach. A bet on brand power and consumer loyalty rather than hard assets. Some analysts were skeptical. Buffett buying a consumer stock? That's not his style. Is he abandoning value investing? But Buffett had evolved. Influenced by his partner Charlie Munger, he'd begun to see that paying a fair price for a wonderful company beats paying a wonderful price for a fair company. The question was, after 58 years of walking past this opportunity, had he finally gotten it right? Here's where the story takes an unexpected turn, because this isn't really a story about what happened after Buffett bought Coca-Cola. It's about the 58 years before, the decades of blindness, the invisible trap that kept him from seeing what was obvious. Let's rewind. 1930s and 40s. Young Warren Buffett selling Coca-Cola bottles door to door in Omaha. He saw the profit margins firsthand, watched customers buy the same product repeatedly, witnessed brand loyalty in action. Warning sign number 1. The economics were exceptional. His reaction? He invested in street railway companies instead. Classic Graham-style cigar butts, cheap assets, low multiples. 1950s and 60s. Buffett was building his investment partnership, making his reputation, following Benjamin Graham's value formula religiously. Buy undervalued companies below book value. Avoid anything trading at a premium. Coca-Cola consistently traded at premium valuations. It didn't fit the checklist. Warning sign number 2. Coca-Cola was consistently outperforming his value picks. His reaction? Stick to the formula. The formula works. Don't deviate. By the 1970s, Coca-Cola's strategy had drifted. The company diversified into unrelated businesses: wine, shrimp farming, theme parks. Stock performance became mediocre. And Buffett's brain said, "See? I was right to avoid it." Expensive stocks disappoint. Confirmation bias was taking hold. Every time Coca-Cola stumbled, it reinforced his existing belief. Consumer brands are too expensive. Stick to value stocks. Warning sign number 3. Even during the drift years, Coca-Cola's core brand loyalty remained intact. The moat was still there. His reaction didn't matter. The stock was expensive. Next, then 1981 arrived. Roberto Goizueta became CEO. He immediately started fixing things, sold the distractions, refocused on beverages, launched international expansion with precision. The transformation was dramatic. Revenues climbing, margins improving, market share expanding globally. This wasn't the drifting company of the 70s. This was a machine. Warning sign number 4. Buffett's friend, Don Keough, was president. Keough personally explained the strategy, the international opportunity, the brand's untapped potential in emerging markets. His reaction? Interesting, but still too expensive by traditional metrics. Maybe later. The anchoring was complete. Buffett's brain had created a category. Coca-Cola equals too expensive. And once that anchor was set, every new piece of information got filtered through it. Then came April 1985, the new Coke disaster. Coca-Cola announced they were replacing their century-old formula with new Coke. The backlash was immediate and overwhelming. Protests in the streets, angry phone calls flooding headquarters, people hoarding cases of the original formula. The media called it one of the biggest marketing blunders in history. The stock dropped. Analysts questioned management credibility. But here's what most investors missed, and what Buffett almost missed. The outrage proved something extraordinary. Coca-Cola wasn't just a beverage. It was part of people's identity. Customers weren't rationally choosing a sugar water product. They were emotionally attached to a brand. Warning sign number 5. The new Coke backlash revealed a moat deeper than any financial analyst could measure. By July, Coca-Cola brought back the original formula as Coca-Cola Classic. Sales surged. The brand emerged even stronger. Buffett was watching. He understood what had been revealed, but he still didn't buy. The mental anchor was too strong. Coca-Cola is expensive. I don't buy expensive stocks. For 2 more years, he watched. Goizueta's strategy kept working. International expansion accelerating. Brand value compounding. The stock climbing. And then October 19th, 1987, Black Monday, the market crashed. 22% in one day. Coca-Cola fell with everything else, not because of company problems, but because of market panic. By December 1987, Coca-Cola's stock had been significantly marked down. The company's fundamentals were stronger than ever. But the price was finally approaching something Buffett could rationalize. This was the catalyst, not because Coca-Cola had suddenly become a better company, but because the price had fallen enough to overcome his mental anchor. In his mind, Buffett could finally justify it. It's not expensive anymore. The crash created value, but here's the truth. Coca-Cola had been undervalued for years, even at higher prices. The real value wasn't in the balance sheet. It was in the brand, the global distribution network, the emotional moat that the new Coke disaster had revealed. Buffett had been looking for cheap prices on hard assets, but the greatest value was in something intangible, something his framework wasn't designed to capture. January 15th, 1988, Buffett finally started buying. He would invest $1.3 billion over the following months. 400 million shares, the largest concentrated position in Berkshire's portfolio. After 58 years of walking past it daily, he finally bought Coca-Cola. But the question lingered, why did it take so long? What invisible force kept one of history's greatest investors from seeing what was always there? So here's what was really happening. Warren Buffett wasn't avoiding Coca-Cola because of careful analysis. He was trapped by two invisible psychological forces that affect amateurs and legends alike: anchoring bias and status quo bias. Let me explain these simply, because understanding them is crucial. Anchoring bias is when your brain fixates on an initial piece of information, a belief, a number, or a rule, and then interprets everything else through that lens. Even when new evidence contradicts it, your mind finds ways to preserve the original anchor. It feels like logic. It feels like discipline, but it's actually a trap. Status quo bias is its cousin, the tendency to stick with current behavior simply because it's what you've always done. I've never owned consumer brands, so I shouldn't start now. The longer you maintain a behavior, the harder it becomes to change, even when change would be beneficial. Together, these biases create a powerful prison, especially for successful people who built that success using specific rules. Here's how it manifested in Buffett's case. Evidence number 1. The Benjamin Graham anchor. Graham taught Buffett to buy undervalued assets trading below book value. This was the gospel, the formula that made Buffett wealthy through the 1950s and 60s. Coca-Cola never traded below book value. Not once. It always commanded premium valuation. So Buffett's brain automatically categorized it. Expensive equals bad investment. But here's what he missed. For certain businesses with durable competitive advantages and powerful brands, expensive can still be cheap. The framework that worked brilliantly for industrial companies and struggling retailers didn't apply to global consumer monopolies. The anchor prevented him from seeing Coca-Cola's true value for 5 decades. Evidence number 2. The self-reinforcing loop. Every year Buffett didn't own Coca-Cola reinforced the decision. I've avoided it this long. Must be for good reason. Status quo bias made not owning Coca-Cola feel safe and familiar. Buying it would require admitting 50+ years of error. That's psychologically painful, even for Warren Buffett. Especially for Warren Buffett, whose reputation was built on never making mistakes. The longer he waited, the harder it became to change course. Evidence number 3. Selective interpretation of evidence. When Coca-Cola succeeded in the 60s and 70s, Buffett's brain said, yes, but it's still too expensive. When the company drifted in the late 70s, his brain said, see? I was right. Management makes mistakes. Expensive stocks disappoint. When Goizueta turned it around in the 80s, his brain said, interesting, but the valuation is still too high. When New Coke failed, his brain said, management blunder. Justified my caution. At every turn, Buffett's mind filtered information to confirm his existing belief. He wasn't seeing Coca-Cola objectively. He was seeing it through the lens of his anchored assumptions. So why do even brilliant investors fall into these traps? Reason 1. Early success creates rigid rules. Buffett made his fortune following Graham's value formula. That success reinforced the approach. Don't change what's working. Makes perfect sense. Until the world changes and the old rules stop working. Reason 2. Expertise can become blindness. Buffett knew Coca-Cola intimately. He'd drunk it for 58 years. That familiarity created the illusion that he'd already evaluated and rejected it. Actually, he'd never properly analyzed it because it didn't fit his checklist. Sometimes experts miss opportunities in their own domain because they assume they've already considered that. Reason 3. Anchors are invisible. You can't see your own anchors. They feel like principles or discipline or wisdom. Buffett thought he was being prudent by avoiding expensive stocks. He didn't realize he was trapped by an outdated framework. So what finally broke through? 2 things: Charlie Munger's influence and the 1987 crash. Munger had been preaching for years, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This gave Buffett permission to reconsider his anchors, an external perspective to break the internal loop, and the 1987 crash created a price discount. This was psychologically crucial. It allowed Buffett to buy Coca-Cola while telling himself, the crash created value. I'm still following value principles, even though Coca-Cola had been undervalued before the crash. Even though he should have bought it years earlier, the crash gave him an excuse to overcome his bias. In his 1989 shareholder letter, Buffett wrote this, dripping with sarcasm. I had been drinking Coca-Cola for 58 years, and I never bought one share. This Coca-Cola investment provides yet another example of the incredible speed with which your chairman responds to investment opportunities. No matter how obscure or well disguised they may be, he was mocking himself, acknowledging the 58 years of blindness. The self-awareness is what separates great investors from good ones. Now, let's talk about the outcome. Initial investment, 1988 to 1994, $1.3 billion, 400 million shares, average cost basis, approximately $3.25 per share. Today, as of 2025, Berkshire Hathaway still owns all 400 million shares. The position has never been sold. Annual dividend income, $816 million per year. That's $2.2 million every single day. Just in dividends. The stock has split multiple times. Adjusted for splits, the original shares have appreciated over 1,500%. Add in the cumulative dividends over 37 years, approximately $11.7 billion in dividend income alone. Total return from a $1.3 billion investment, over $25 billion and counting. It's become one of the single best investments in Berkshire Hathaway's history, all because Buffett finally overcame his anchored beliefs at age 58, the lesson he took from it, and his own words, I should have bought Coca-Cola 50 years earlier. The best investment you never made might be one you've looked at 1,000 times. Your rules and principles got you where you are. But sometimes the next level requires questioning those very rules. So what does Warren Buffett's Coca-Cola story teach us? Especially if you're 50 or older with your own decades of anchored beliefs about money, investing, and risk. The core insight isn't about finding hidden opportunities. It's about recognizing that your own expertise and past success can become your biggest blind spot. Consider 3 patterns from this story. Pattern 1, the I already know that trap. Buffett had looked at Coca-Cola countless times over 58 years. Each time he dismissed it because it didn't fit his framework. He assumed he'd already properly evaluated it. Actually, he'd never truly analyzed it because his anchor prevented objective assessment. Ask yourself, What investment or strategy have you avoided for years simply because you've always avoided it? Is that avoidance based on current analysis, or is it anchored to old beliefs? Pattern 2. Rules that worked yesterday may not work tomorrow. Buffett's buy below book value approach made him wealthy for 30 years, but it would have caused him to miss one of his greatest investments. The rule was right for its time. Then the world changed. Consider, which of your investing principles are timeless wisdom, and which are just habits from a different market environment? Pattern 3. Concentration versus diversification. Buffett invested $1.3 billion into a single stock, 6.2% of an entire company. His largest position. Conventional wisdom says diversify to reduce risk. Buffett's philosophy? Concentration decreases risk if you truly understand what you own. Reflect on this. Are you diversified because it reduces risk, or because you don't have conviction in any single opportunity? Here's why this matters, especially for investors over 50. At 50 or 60, you have more experience, more wisdom, and more resources than ever before. But you also have more anchored beliefs. Buffett made this investment at age 58, exactly when conventional wisdom says you should be playing it safe and diversifying away risk. Instead, he made his most concentrated bet on a single company. Today, it generates $2.2 million daily in dividends alone. The lesson isn't go make concentrated bets. The lesson is don't let your decades of experience become your prison. Buffett earned 99% of his wealth after age 50 precisely because he remained willing to question his own assumptions. If Warren Buffett can admit he was wrong for 58 years, what might you be wrong about? This analysis of historical investment decisions is for educational purposes only, not financial advice. Warren Buffett's circumstances, risk tolerance, and expertise are unique. Before making any investment decisions, consult with a licensed financial advisor who understands your specific situation, goals, and constraints. Of course, Buffett didn't get every concentrated bet right. Sometimes anchoring to success can be just as dangerous as anchoring to rules. In the next video, we'll examine the flip side, Buffett's $3.5 billion mistake, where his confidence in his own expertise cost him 1.6% of Berkshire Hathaway, and the devastating bias he fell into, despite decades of warning himself about it.